From food and petrol to used cars and clothes, consumer prices are surging across the globe as economies recover from the coronavirus pandemic. Supply chains are struggling to keep up with pent-up demand, with businesses passing on higher input costs to consumers. Investors are also starting to worry that central banks might step in to keep prices in check by raising interest rates. Paolo Montecillo reports.
Builders rush to turn this former corner office in London into a cafe. Its owner hopes to cash in on the easing of lockdown rules to allow indoor dining. But the contractor says the project could be going a lot quicker.
Right now, you've got shortage of materials, you've got shortage of labour, you've got shortage of skills. I mean, for the small builder right now, he is going through multiple challenges.
The British construction industry is currently on shaky ground. Companies are struggling to get workers because of Brexit, and rising demand from overseas has pushed up the cost of imports.
There's been a sort of perfect storm, really. There's also been the problem of importing materials from the EU. So that has meant there's been severe price inflation.
Consumer prices in the UK rose 2.5% in June, the fastest year-on-year rate in 3 years. And it's not just in Britain. US inflation hit a 13-year high of 5.4% in the same month. In India, consumer prices eased slightly to nearly 6.3%, but remain above the central bank's 4% target. Small businesses and households have felt it most keenly, but investors worry higher inflation may pressure monetary authorities to reduce support for the economy.
If earnings estimates are disappointing, or if inflation interest rates rise more than expected, given the move the market's had, it's likely stocks are going to go down.
The U.S. Federal Reserve says the acceleration in price increases is temporary, a reflection of how much demand has recovered from last year's slump. The American and British central banks are expected to keep interest rates at record lows for now, laying the groundwork for a more stable post-pandemic recovery. Paolo Montecillo, TRT World.
Well, let's get more on this now with Matt Maley in Newton, Massachusetts. He's Managing Director and Equity Strategist at Miller Tabak. Great to have you back with us, Matt. Now, many people had foreshadowed an increase in inflation as economies reopened during this pandemic. More people are now willing to open up their wallets, and supply is struggling to keep up with this pent-up demand. But did you imagine that prices would rise by so much so quickly? In the US example, 5.4% in June?
Yeah, it's definitely been a surprise, and but one of the things too is that the people saying, a lot of people, of course, Chairman Powell saying it's going to be a transitory situation, but of course the concern is, it'll almost certainly come down from the highest level it reaches right now this summer, but it'll likely plateau at a level that's still going to be a lot higher than it was before the pandemic. I mean, you look at the lumber prices and corn prices and wheat prices, they've come way down from their spring highs, but they're still well above where they were back, right before the pandemic. So, the average price of like 2019. So there's still a lot of concerns out there, and it could be a problem. That's something that could bite the Fed if they don't do something about it.
That's right, and the world's central bankers, including the US Federal Reserve, have been at pains to reassure markets, reassure the public that, as you say, any price increase that we're seeing is simply temporary. Do you share that view, and how long is temporary exactly?
Yeah, I don't share that view simply because a couple of things. I mean, number one, a lot of it also has to do with wage inflation. And once you start to get into wage inflation, that's a lot harder to pull back from. So once people get higher from a certain level, it's hard to dock them pay. And then if you don't do that, what you do is lay them off. And of course, that's bad for the economy and also bad for the stock market. So inflation is really not great for a lot of assets, for any asset really, except for maybe gold. And the thing is, with the Federal Reserve, what they're doing, at least in the U.S. here, is they're keeping emergency level stimulus at a time where the emergency has already passed. I mean, they don't have to go from 120 miles an hour to zero, but they do need to pull back at some point. Otherwise, they risk overheating and causing more serious problems to the economy later on.
Yes, and that leads me perfectly into my next question. As you say, central banks around the world have been really looking to prop up the global economy during this pandemic by buying up masses of bonds. They're keeping interest rates at historic lows. How much longer can they sustain this? And do you think the pressure is now increase and on these policymakers to actually ease up on these measures sooner rather than later?
Yes, I think it does because again you're creating an issue where things can get too much. I mean, it's great that it's helping the bull market to sustain itself. I mean, there's nothing wrong with the correction. First of all, those are normal and healthy anyway. But it would be great. I mean, I just think the risks are getting too much for them to keep this emergency style stimulus going because not only could it cause a high inflation, but it could also inflate the kind of bubble that will be very hard to recover from once any bubble they're always inevitably burst. You don't want that. So do they really want to have that kind of situation where they create higher inflation and or create higher asset price inflation that creates the kind of bubble that will again make things worse down the road? And we have to take our medicine a little bit, even if that slows down the rise in the economy and in the growth. I mean, again, we're still in the early ages of that of the economic growth, so I don't think it'll completely shut it down.
Okay, Matt Maley from Miller Tabak. It's always great to get your analysis. Thank you again for joining us on Money Talks.